Somebody,
Yeah, there we go.
last
Slide it
month,
over. Okay.
That
Perfect.
was the same situation. They got married, living with mom, and this sucks.
What do I need to do to get out of this?
Yeah, he's feeling for his wife who's living with her mother-in-law, you know?
Oh yeah,
That's what they thought. Hey, it's not gonna be
that was not flying in the
that
house.
big a deal.
Yep. Yeah. Oh, no kidding.
What is that down payment assistance program exactly like?
Well, there are
The money's actually not free.
correct. There are like 8 or 9 different programs. There's Texas Department of Housing and Community Affairs, TDHCA. There's Texas State Affordable Housing Commission, which is TSHAC, and then there's SET. And so these 3 different programs all have different terms, and some of them are an actual grant, or it's money given to the client for their down payment. You don't have to pay it back. It's forgivable after a certain amount of time. A lot of them are second liens, so it's actually it's kind of like a second mortgage, but you don't make payments on it. So after a while, it's either forgivable, or when you sell the house, you have to pay it back, depending on how long you own the house. But like you said, it is not free money, and that's what I show clients when I meet with them.
Qualified.
Exactly.
Okay.
Yeah. So there's income limits depending on the program, most of which are either 86,000 or 99,000, depending on the size of the family. If you make more than that, you usually will not qualify. There's actually a down payment assistance program that does not require you to be a first-time home buyer. So just because they bought a house before or owned a house recently. We had a client recently rent out their current home and buy a home with down payment assistance. So they bought a new home with 0 down and gained a rental property.
Wow.
Those numbers were barely, the numbers have to work perfectly to make that work, but you got a lease agreement signed before, so we use that income, and there's different ways to make that work. But yeah, so what I always like to do with clients is, I look at down payment assistance as a great last resort. And the reason I put it that way is, if you can get a gift from a relative, if you can liquidate money from your 401k, sell a car, whatever you need to do to come up with the down payment yourself, you're gonna save a lot more money. Because right now we're looking at FHA rates as low as 3.625% right now as of today. So if you're getting an FHA loan at 5.125, yeah, you're getting free money, but you're paying it back in like 3 or 4 years.
Right.
So if you will plan on owning that home for 5+ years, if you can come up with the down payment yourself, great. That would be ideal. But that's all part of what we do is we educate them on the pros and cons of it and let them make their decision. Because bottom line, getting into a house now, even if you're paying more, is going to get you more equity than waiting to save like a down payment.
Right.
Yeah, especially if rates go up. Yes. All right. So the first hour or so of the class, I'm going to kind of go through just the basics, the different types of loans, different scenarios, stuff that you, like I said, you as realtors, the main takeaway, you don't need to be mortgage experts. Kind of just need to know the basics. The main takeaway is if you have questions, call me. I'm always happy to help. I'm always good to be a resource for you. As far as I want to focus on stuff that's going to help you as both a buyer's agent and a listing agent. And then the second hour, more strategic ways to utilize like mortgage and lending to help you grow your business is what the second half of the class will be. So what I like starting with is types of lenders. So the reason being is, especially as a listing agent, let's say you're getting multiple offers, you kind of want to know where the lender is, who's underwriting that client, who's pre-approving them, and everything that goes with it. So I have worked at all 3 of these types of lenders, so let's start from the bottom. So there's big banks and credit unions. A lot of people like the idea of that because, they bank with Chase, they want to have their mortgage with Chase, et cetera, et cetera. And there's definitely some advantages to that. Banks, my advice is just to ask other agents in the office on that as far as it goes. Just like any company, any mortgage company out there, if you go into a branch like that, you could be working with a loan officer who's got 25 years experience and is great at what they do, or you could be working with me in 2005 who had just gotten out of a 2-week training program and could barely spell the word mortgage. So it's just, you really don't know what you're getting when you walk into there, so you want to make sure you're with someone experienced who can walk you through the process and let you know, educate you on all your options. Bigger banks, they have so much other stuff they do, credit cards, business loans, you name it, that sometimes the mortgage service can struggle. They do miss closing dates from time to time, things like that take a little bit longer to close loans. And then there's mortgage brokers. When I first moved to Austin, I worked for a broker, and it's definitely got its advantages. It's our particular company had 45 different banks that we could choose from to send any given loan. So you shop around for the best rate, the best closing costs, different programs, down payment assistance, MCC, things like that. There's a lot that goes into it. So the problem is once you choose that bank, the loan's out of your hands. You're at the mercy of their turn times. You know, it's just, you can't call in favors or anything like that, which brings us to mortgage bankers. The majority of local lenders in Austin, Round Rock, Georgetown, everywhere like that are mortgage bankers. So you're all the names that you hear around town, the Benchmarks, Prime Lending, Supreme Lending, Fairway, Legacy, all of us are all mortgage banks, which means basically we underwrite, close, and fund the loan in-house, and then after closing, we sell it to a big bank to service it. So we will actually do all of this stuff in-house. The beauty of that is that, you know, I have personal relationships with the underwriters in my office. They're actually in Austin. Our turn times are way quicker. We just took over a loan that was declined by a big out-of-state bank, and we closed it in 11 days. So that's the big benefit, is we can call in favors, we can request rushes, and whatever it's needed, we can make sure it happens for your client. So it's kind of the best of both worlds, in my personal opinion, as a mortgage banker, because you know, you have all the low rates that the brokers have, but you also get to have all the in-house service that is unavailable elsewhere. So that's just to give you an idea. From a listing agent's perspective, don't judge a book by its cover kind of thing. My recommendation is if you have multiple offers and multiple pre-approval letters, what do? Call the lender. Call the loan officer on the pre-approval letter. Ask them a lot. There's plenty of questions you can ask them. Are they fully pre-approved? Have you seen their tax returns? Are there any contingencies that I need to know about? And you can just ask all those questions. More than the questions, call them just to see if they answer their phone or return your phone call. I hear it all the time. Yeah, I can't get a hold of the lender. I can't get the lender on the phone. Things like that. So you're interviewing to make sure, you know, that a pre-approval is solid. So has everyone heard the term pre-qualification and pre-approval? And does anyone not understand the difference between those? So a pre-qualification can be done in like 5 minutes. And for lack of a better term, it's useless. I would highly recommend clients staying away from that. You can go on online websites, your Rocket Mortgages, stuff like that, knock out a pre-qualification just by filling out a loan application. You get a piece of paper. The best example I can think of. So when I started originating in Austin full time, I was at the Keller Williams Round Rock office with United Lending, and I was their in-house lender for 4 years. And an agent kept coming by my office, and he's like, "I got this client. I really want her to apply with you, but she's with her bank." And this goes on for 6 months. He's like, "I'm trying to get her to come here." And finally, she comes and fills out an application with me. So on her application, she put that she makes $3,000 a month in salary and $3,000 a month in bonus. She filled that out on my website. So the first thing I do is I call and I verify how she's paid. So you get a $36,000 a year salary, yes, and at the end of the year you average about $36,000 a year in bonus. And she's like, no, I get a $3,000 bonus at the end of every year. So that other lender pre-qualified was $6,000 a month in income. I'm at like $3,250. So you don't qualify to buy a $200,000 house, you qualify to buy a $125,000 house. And that was a hard conversation to have with her. She's been going around looking at $200,000 houses for 6 months with her pre-qualification letter. And if they would have gone under contract, she would have paid for an appraisal, she would have paid for an inspection, she would have lost her option money, and then the loan would have gotten declined as soon as they verified all that. So that's the importance of doing a thorough pre-approval up front. I don't differentiate between the two. There's a pre-approval or nothing. We do a very thorough job of looking at all income documents, third-party verifications, tax returns, you name it, before we put someone in your car for you to go show them houses. I think that's really important, just to not waste anybody's time. And the buyers too. I mean, that's like that example. They get their hopes up looking at homes in a certain price range that they don't qualify for. She was really, really sad. She had to sign a lease. So that's the importance of a very thorough pre-approval up front. So there's tons of different types of loans out there. There's the 4 major loan types, which we'll go over shortly, but there's tons of reasons for getting a mortgage. So there's your single family residence, which obviously is the most common in these areas, but there are 2 to 4 units. So your duplexes, triplexes, quadplexes, things like that. There are different down payment requirements for that. Multiple unit properties, if you're going to occupy one of them as your primary residence, you can get an FHA loan on a 4-unit property, which is 3.5% down. So for someone who is not particular as far as having their own yard and their own privacy and everything like that, I've had some clients buy 2, 3, and 4-unit properties with just the minimum down, and then once you factor in rental income, it's almost like they're not paying a mortgage. So if you find some of those properties and you have a client that's interested in it, it's a great option. If you're buying it as an investment property, a multi-unit property, you need like 25 to 30% down. So those as a rental property, it's much harder to get into. So we have your 4 main loan types. Yes?
How long do they have to live in it?
The technical answer is a year. So when a client signs a deed of trust at closing for a primary residence, they say, I will occupy the home within 60 days of closing, and I intend to live there for a year. That's the actual legal verbiage that they sign. If life happens and they lose their job and have to rent out the residence because they can't afford the mortgage payment, they're not going to get in trouble if it's less than a year. But if it's obvious that they are just moving it in for 3 months and then renting it out, then yes, they could get in trouble for a mortgage fraud if they're not actually intending to occupy it. But
They
it's
occupy it for a year and then move out.
go for it, exactly. I got a lot of clients that have done that. I got a lot of VA clients that do that. So they'll do 0 down, move into a home, stay there for a year, and that's their new rental property. So it's definitely a good tool to go about.
How you doing?
Doing good.
So once they rent out the property using the VA loan for 0 down, can they turn around and buy another house at 0 down?
Yes,
Really?
one time.
Okay.
So you can have 2 VA loans. Well, technically you can have more, but so there's a worksheet to calculate their additional entitlement. That's one of the biggest misconceptions about VA. I hear about that. I hear lenders tell clients that you have to sell your house or refinance out of a VA loan to restore your VA benefits. That's not true. There is actual remaining entitlement. It is up to a certain amount. It usually means you can do 0 down up to about $280 or so on a price on your second one. I mean, you can go as high as $480, but it requires a down payment.
Yeah.
But a VA loan is still going to be your best bet. There's 0 mortgage insurance, very little down, if any, is required. So yes, you can use a VA loan twice, absolutely.
And that 280, that fluctuates depending on the market, right?
No, it's not the market so much as how much of their, so when we do a VA loan, we request a certificate of eligibility from the VA, and it says you have used up $36,000 of your entitlement. Depending on how big the house was or how small the house was on the first one they purchased, sometimes it's more or less. So you actually plug it into a formula, say what is the price of the house they want to buy, and then it'll show you the minimum down payment. So if it's $300,000, maybe you need $5,000 down or something. It's still very minor. It's much easier than a conventional or FHA loan. All right, so let's talk about occupancy real fast. So FHA, VA, USDA, all are required to be primary residence homes. If you're trying to buy a second or vacation home or a rental property, you are going conventional. Anyone care to guess the minimum down payment on a second home or vacation home?
30?
5%?
10.
10.
Yeah. 10% down on a second or vacation home. Now this has to be if you look at it from an underwriter neutral perspective, it has to be obvious it's a second home or vacation home. In other words, if you live in Round Rock, no one's going to buy that you are getting a second home in Buda or something like that. So, it has to make sense. It doesn't necessarily have to be on a golf course or waterfront or anything like that. Out-of-state clients, a lot of the time, they'll buy a house in-state to be closer to their kids. That's a second home. And you can do 10, 20% down, whatever you want, but the good thing is that on an investment property, the interest rate's about 0.75% higher than a primary. A second home's the exact same. So you get a lower rate with a second home, and you can do less down. So you can do 10% down instead of 20. Here comes a trick question. What's the minimum down for an investment property?
20.
It is technically 15. No one ever does 15 because the PMI is horrifically high and it ruins your cash flow. But there is options out there for a 50. Fannie Mae does allow it. So it's 20. 25 is absolutely ideal. You get a nice, usually about a 0.5% break in your interest rate if you do 25% instead of 20. Which for investors, that usually really helps the cash flow. But 20 and 25 is the most common down payments down on those rental properties. And I say rental a lot, that just means non-owner occupied. So if they're buying a house for a kid or something like that, that's non-owner occupied. It doesn't mean they're going to be claiming rental income necessarily. A good script to keep in mind when you're talking with clients, if you have a client who wants to invest in real estate, the biggest hurdle to buying a rental property is having 20% down. It's hard to save up that amount of money. You know, that's a $300,000 house, that's $60,000 down. So I always use this when I talk to clients. Feel free to use it yourself. The cheapest way to acquire a rental property, rent out your existing home and buy a new primary residence. Because you can buy a new primary with 3 or 5% down at a lower interest rate, and you can rent out your existing home. So it is a much more cost-effective way, both interest rate-wise and cash out-of-pocket-wise, to start acquiring rental properties. Like you mentioned earlier, I see a lot of clients do that. They buy a primary residence, live in it for a year or two. They start low with a starter home, buy up a little bit, live in that for a year or two, buy up, and they're putting 3 or 5% down on each home, and all of a sudden they own 3 houses, and the other 2 are usually cash flowing from that. So.
There's no limit to that?
You can have 10 mortgaged properties. And that's another thing a lot of people will tell you 4 because they have like overlays. In other words, like their own company's guidelines. Fannie Mae allows up to 10.
Without having an LLC? Or
Mm-hmm.
like that?
Yeah.
Wow.
Yeah. A lot of investors do put properties in an LLC. We don't lend to LLCs. Bigger banks will. We need that personal guarantee. We have to lend to an individual. But it is pretty common. There's fixed rate loans and there's fixed period ARM loans. ARM means adjustable rate mortgage. I have done 0 ARM loans in the last 4 years, and that's I think it's almost irresponsible to do so. Unless you have a very savvy investor client who knows for a fact they're going to sell this home in less than the period where the rate is fixed. So if it's a 5-year ARM, they're going to sell the house in 4 years. Maybe we'll talk about the numbers. But honestly, investors have such a high appetite for fixed rate mortgages right now. The rates aren't that different. They used to be really different back in the mid-2000s and everything. That when I was first getting started in 2005, 6, and 7, the difference between an ARM and a fixed rate was huge. Now it's like 0.25%, so it doesn't really make a huge difference in the payment to take on that kind of risk. So let's get into, all right. So as a mortgage banker, as a lender, we kind of all play by the same rules. And they're made by Fannie Mae and Freddie Mac for conventional loans, or Ginnie Mae for your government loans. And I wouldn't say it's black and white, but it kind of is. There is an online underwriting system. It's called AUS, Automated Underwriting System. Every file has to go through it. Anyone who's buying a house, we send it through this computer system, and it spits out an approval or a denial. And it says, if it's approved, and you have to provide this. And it's 30 days of pay stubs, 2 years of tax returns, 2 months of bank statements. And it guides us on that. And there's different requirements for different properties and different types, like occupancy types, things like that. So, and it's way more detailed than that, but just a quick breakdown. We do have automated underwriting that is done by the rules are set by these entities. On a conventional loan, so whoops, I need to update this flyer. The loan amounts that have increased at the beginning of this year. So there's 4 main loan types. Let's start at the bottom, VA and USDA. What do those 2 loans have in common?
100%
Exactly. Those are the only true zero down mortgages out there. VA, like we discussed, by far the best mortgage you can obtain. 0 down, 0 monthly mortgage insurance. You can use they have lower credit score requirements. We can go down as low as 580 in most cases. Ideally we want 620 or 640. There is a funding fee that is financed into the loan amount. It's not money that you have to pay at closing. From a realtor's perspective, the things you want to keep in mind when you have a VA buyer, that's the only loan where we require a termite inspection on the property, a WDI report with destroying insect. It has to have a clean termite report. Any damage or conducive conditions need to be repaired prior to closing. So there's some disagreement on who's required to pay for this. And everywhere I've ever worked, I've heard different elsewhere, but everywhere I've ever worked, the veteran can pay for the inspection, but if repairs are required, the seller has to pay for them. It's a non-allowable fee. The buyer cannot pay to fix up termite damage.
So you just said that typically the buyer pays for the inspection?
They usually get it at the exact same time as the home inspection.
Okay.
Yes. And it's perfectly okay with us for the veteran to pay for that. I've heard other lenders disagree and say the seller has to pay for the termite inspection, and never seen that be the case. That kind of results in most sellers don't like being told they have to pay for something after they're under contract to sell their house, so it can lead to some animosity there. Let's see, so you can also use your VA benefits to buy land, like vacant lot or raw land. You can go up to about $150,000 price with 5% down. That's pretty cool because most land loans require 25% down if you're not a veteran. So that's a very good benefit. Those are done directly through the Texas Veterans Land Board. I don't do land loans, so and neither do like local lenders usually. So let's see. Texas Vet also has rate reduction loans. So if someone has a 30% disability or higher, they can qualify for a discounted rate on VA. We waive the funding fee if they have a disability rating, little things like that. So there's definitely benefits depending on the VA. Long story short, VA has a lot of ins and outs. It's kind of complicated. Just make sure you're working with someone who's familiar with the loan type. That's my best advice. All right, so does anyone know, as far as a USDA loan goes, what that entails? So it's a loan that's guaranteed by the Department of Rural Development, and essentially it's to help develop rural areas. So up until
the boundaries.
yes, that's exactly what I was about to go over. So last year they finally changed the map after like a decade of saying they were going to every year. I felt like an idiot. I would stand in this room once a year and be like, VA's going to change the map next month, and then the day before it's supposed to change, they're like, oh no, never mind. So they just kept the same thing. It was based on like the 2010 census data because two of the biggest areas that we did USDA loans in were Hutto and Leander, which are not rural areas by any means, right? Yeah, so they are now considered pretty much ineligible. So what I did, let's see here. So whenever you have a listing and you're trying to decide if it is USDA eligible, search USDA property eligibility. So if you Google that, it will come up. The first result is this website here, and you actually get a map. Anyone have an address off the top of their head? It can be this one.
120 Cavalier Cove.
Did I spell that right?
Sure.
Where is it?
Hutto.
So the reason I want to show you an example, basically, hey, you found a very small pocket of Hutto that is USDA eligible.
Mm-hmm.
Very nice. So the reason I do this is because it is black or white. It is eligible or it isn't. There's no gray area. It's just by address. So what I always tell you guys to do to be familiar with what is what, just zoom out. Just type in any address, go to this website, and zoom out. And as you can see, these shaded areas are ineligible. So Georgetown, Round Rock, Pflugerville, Austin, Manor, and then everything outside of that in white is eligible. So we're seeing little pockets of Hutto, Jonestown, Lago Vista, Liberty Hill, Taylor, Elgin, Bastrop, Buda and Kyle were, and that was part of the areas that were removed last year. So, just that's a decent exercise you guys can do. Is just go online and take a look and just get familiar with it. But always check your exact address every time.
Does it get updated real time, or is that like?
They've changed this once in a decade. So it will the map will always be what it is until USDA changes the entire map. And they do it based on census data, based on population in rural areas and things like that.
So it's once every 10 years?
No, I mean like they reserve the right to do it whenever they want.
Okay.
Yeah, but I remember in 2011 was the first time that they got the 2010 census data. In 2011 they said they were going to change the map, and then they went back on that and said no, and they did that every year up until last year, and they finally did it. So I think it was mostly because of like lobbying and people didn't want that to go away and everything like that. But
So what if you have a client that says, okay, we found a home that's within the USDA area, but then, you know, it takes them 30, 60 days, whatever, to close, and then it changes before closing?
so usually, they announce their intention to change the boundaries of the map months ahead of time.
Okay.
So if there was any concern, and then they'll put it. What they did was they had a separate map of proposed changes, so you could kind of see if yours was in jeopardy, and if so, you can rush it through and get that commitment from USDA up front. So from your perspective on USDA loans, the key things to remember are, so first of all, it's a lot harder to qualify for now. The debt ratio requirements are much stricter than like your conventional and FHA loans, so just getting the loan itself is difficult. There are county income limits, just like I mentioned earlier about down payment assistance. You can't make more than a certain amount. I think it's like $94,000 right now. So on USDA, you have to have a really solid pre-approval in place. You have to make sure the property's eligible. They take longer to close. So your average loan, we process it, we put it in underwriting, we get our clear to close, and we send closing instructions to title. And then we're done. On USDA, we do all that up until we get the clear to close, and then we ship the file to their Georgetown office electronically, and they do a second review before they issue their guarantee. Depending on how busy they are, sometimes they issue their commitment in 2 days. The longest I've ever seen it take is 28 days. That was back when USDA was a lot more common, so I don't think we're going to run into that anymore because the boundaries have tightened up so much they don't get as busy. But yeah, just keep that in mind. I always say build in closer to. I always say comfortably I can close any mortgage in 3 weeks or less. USDA I usually ask for at least 30 days, just to give us that extra week to make sure USDA will review it and issue their commitment. But yeah, it is zero down. There is a little bit of mortgage insurance, but it's cheaper than both FHA and conventional loans. So it is a decent option for zero down. So let's say someone wants to buy a home, they want to put zero down payment down, they're not a veteran, and they don't want to move to Taylor. So if that's the case, then our only option are down payment assistance loans. So that's where being able to educate the client on the pros and cons of all the different programs we discussed earlier comes into play. I always say if you can get a gift from a relative, that's the best way to go. It's easy to document, you get the lowest possible interest rate, but there are definitely pros and cons to each. All right, has anyone ever heard of a portfolio loan before? So the portfolio loan is private money, basically. So money from a bank or sometimes even an individual to where they will make a loan that does not meet your standard guidelines that I just went over as far as Fannie Mae, Freddie Mac, Ginnie Mae, all those loans. If someone doesn't qualify for whatever reason, a portfolio bank may be an alternative. So an example of that, our parent company, Crockett National Bank, they're out of San Angelo, Texas. They are a portfolio lender. And the way I like to call them is they do common sense loans. If you have 20% down, good credit, but for whatever reason you don't qualify for a traditional loan, maybe you're self-employed and had a bad year on your tax returns last year, but you have a long history of having good income. Maybe a client I helped Susie Goal with recently was her client just got divorced, had a huge amount of child support, but Fannie Mae requires 6 months receipt of child support before they can count it as income, and she was trying to buy a house right away. She was with an online lender. They declined her loan a week before closing because they didn't meet Fannie Mae guidelines, and as a result, she had a big down payment. They closed the loan in less than 2 weeks. So, like I said, it just makes sense lending. Vanessa, who's my contact over there, she's a great loan officer, super nice person. She described it to me like this. I always like, Scott calls it the cowboy loan because of this. But basically, she said, picture 8 cowboys sitting around a board table and just being like, yeah, I like that one. Like, that's how they make their underwriting decisions. There's no computer involved. It's just that person has good assets, good credit. They're going to pay their mortgage on time. So it's just more common sense. So if you have a client that got declined by a more traditional lender, but they have a big down payment and good credit, let me get you in touch with them. They'll take great care of you, and a lot of times they'll get you into a loan. So the catch, the rate's usually about 5, and it's only fixed for 3 or 5 years. So it's an arm. The idea is get you into the house now, refinance before that rate adjusts, or pay it off, or whatever. So there's also jumbo lenders. A jumbo loan is anything above $484,350. So any loan above $484,000 is a jumbo loan. It has a whole different set of guidelines. There's usually 10 to 20% down requirement. So if you're working with a luxury home, $700,000-800,000 plus, you might be dealing with a jumbo loan. They take a little bit longer to close. Sometimes they require 2 appraisals instead of 1. Just another reason to make sure you're dealing with someone who has familiarity with jumbo loans.
Is it typically a lower minimum credit score for the portfolio lenders?
It's not really a minimum. It's just kind of case by case.
Okay.
Yeah, so they don't have, we have, if you're putting 20% down in a conventional loan, you have to have a 620 credit score, period. If you're below that, you cannot get a conventional loan. You might be able to go FHA or VA, but you can't go conventional. For portfolio, it's case by case. They want to see higher credit. Because if their income doesn't work and you're not qualifying because of your income, they want to make sure you have good credit and good assets. So it's all about compensating factors, basically.
What was that number on the jumbo loan, 484?
484,350. That's the max conforming loan limit for
Jumbo.
the U.S. basically. Yeah. So this is a flyer I give to all my clients when I meet with them. It's our little Monopoly board. I gave you guys a copy. It's just a good visualization of what the process looks like, especially for the client who's usually overwhelmed and uneducated about the process before they start. So I think it's a good tool just to kind of give them an idea. And when I meet with clients, I kind of show them from both angles. Like, obviously you're going to start. The first thing you absolutely need to do is get a thorough pre-approval. Then it's time to shop for a home, to make an offer, negotiate, and then you're under contract, and give an idea that once they're under contract to once they get the keys, on average is about a month. It varies, it's negotiable. It could be 2 weeks, it could be 8 weeks, just depends on what you negotiate. We talk about once they're under contract, I tell them the importance of earnest money and option money and how that works, how they get the inspection, and while they're doing that, we're ordering title, insurance, IRS transcripts, all the stuff we do behind the scenes. And then once they're clear with the inspection, we order the appraisal, gather everything, all their documents up, and we submit the loan to underwriting. Once the underwriter issues their approval, we put together title, insurance, appraisal, everything. We get our clear to close. Buyer does a final walkthrough. We send a closing disclosure to the client at least 3 business days before closing. Now, the reason this is important to know, if you're ever in the dark, like maybe you're on the listing side and you're not getting any updates or something, and you're wondering is closing still on schedule, if title has not approved a closing disclosure that the buyer has signed 3 business days before closing, you're not closing in 3 days. You legally cannot. So it is a federal law that a client has to sign off on a closing disclosure 3 business days before your closing date. Saturdays count, federal holidays do not. So just something to keep in mind if you're not getting updates. If the title company's like, no, I haven't gotten closing instructions yet, and the closing's 2 days from now, well, you're not closing in 2 days. So just keep that in mind, that's another way to get an update. Other things that I beg of you to go over with your clients, I tell them this too, but it's always good to attack from all angles on this one because these are the most common issues that can get a loan declined at the last minute. It's don't make any big cash deposits. Don't make any large purchases on your credit card. Don't change bank accounts. And most importantly, don't apply for new accounts. And that means credit cards, cars, boat, jet ski, whatever it is. Don't finance it. Right before closing, we do two things. Within 5 days of closing, we do these two things. We call their employer to do a verbal verification of employment, make sure they're still employed. I've heard it all. The client just quit 2 days ago. They switched from salary to commission, so we can't use their income anymore. So we verify that they're still paid the same way, that they're still employed there, so no major life changes. And then the one that trips up the most is we do a credit refresh. We don't actually pull their credit, but we take a behind the scenes look and we find out, have they gotten their credit pulled at all since we did? And have they opened any new accounts? And have any of their balances changed drastically? And it's not usually like the loan is declined or not, it's more like, oh, they have a new credit card, we have to send the file back to underwriting. So closing could be delayed. So that's why we say no new accounts, no major life changes, no huge purchases without consulting us first. Clearly, if your car breaks down, you have to buy another car, that's fine, just tell me what the payment's gonna be so we can get it done ahead of schedule, so there's no surprises. So those are the things that we run into at closing. We'll go into that in more detail a little later, have some fun with it. Let's see. Yeah, so that's a good visualization of the actual timeline itself. So we talked about conventional loans. We talked about VA and USDA. So conventional is the most common type of mortgage out there. So it's especially in Austin, in a lot of areas like heavy military areas, like San Antonio, Killeen, even in like Tennessee and stuff. You see a lot more like VA and FHA loans. But in Austin, the average credit score is higher, the average down payment's higher. We do mostly conventional loans in Austin. So with that comes, let me start with FHA. And the reason is, so there's a lot of misconceptions about FHA as well. FHA has kind of a bad reputation almost because of the rule that the government made about 3 or 4 years ago where their PMI, does everyone know what PMI is and what it does? It's private mortgage insurance. All it does is protects the lender in case of a default on the loan. So it is a necessary evil unless the client has 20% down, which especially most first-time home buyers don't have 20% down. So they either have to pay PMI or find a way around it, and I'll talk to you guys about that in a second. But on FHA, yes, the PMI is on there for all 30 years. So a lot of people want to shy away from that. But that being said, FHA has lower interest rates than a conventional loan, and they are not credit score sensitive. So what that means is, to simplify it, if you're trying to do a minimum down loan, if your credit score is above 720, you're probably going to go conventional every time. Or you should, if you can. Once you start getting below 700, FHA is going to give you a lower overall mortgage payment. So as a whole, it has a place for a lot of first-time home buyers. People who are in those 600 credit score ranges only want to put down 3.5%. It's a great mortgage. People get so bent out of shape about the PMI lasting for the life of the loan. On a conventional loan, if you put 5% down, guess when your PMI goes away? Automatically. Like 9 years. Guess how long the average person owns their home?
4.5.
Yeah. 3 to 7. Just depending. So you're probably, the PMI is probably not going to go away on a conventional loan either. So it's, if you're like really comparing the two, it's not a drastic difference between it. I always say, if this is a starter home or a short-term purchase, go with whatever payment's lower, whatever makes more sense for your budget. Because when it comes down to it, the check you write at closing and the monthly payment, I call that the sweet spot. You want to find where those two numbers are both comfortable for you. So that's everything that we do is about your budget. It's not so much about interest rate or whatever. We go over goals and budget to find the right loan for every client that we work with.
Is PMI a percentage of the loan?
Mm-hmm.
What's the percentage?
Well, there are more factors than you'd be amazed how much goes into it. Whether or not there's one borrower or two, it's in tiers of 20. So on a conventional loan, your PMI is different if you have a 680, a 700, a 720, a 740, a 760. Let's see, down payment amount, 3, 5, 10, 15%, all have different PMI rates. So there's a ton that goes into it. On FHA, it's 0.85% of the annual amount if you put 3.5% down. If you do an FHA loan with 10% down, the PMI actually does go away at the end of 11 years. Most people don't really hold that loan long enough to experience that, but there is an option to where you do go FHA and it eventually goes away.
Is FHA required to be first time buyer?
No. But you can usually only have one FHA loan at a time, unless it is due to your family size growing or relocating. You have to have a very specific reason to get 2 FHA loans. But yeah, we use it for repeat home buyers. Speaking of first time home buyer, what is the definition of a first time home buyer?
Never purchased in more than
3 years.
Okay.
Haven't owned a home in 3 years. So if someone had a foreclosure 3.5 years ago, they're good to go with all these first time home buyer products, down payment assistance, tax credits. We'll go over the MCC a little bit later. That's an awesome program. So PMI. There are ways, especially for higher credit score clients, to avoid paying PMI. To avoid it or to get rid of it. So there is upfront mortgage insurance, where you actually buy out your PMI in cash at closing. Long story short, you're basically paying 4 years of PMI right at closing, 4 years of monthly PMI, and you're done with it. So it's not a bad idea for a lot of clients. You put 5% down and pay, like, if you have great credit, it might be like 1.5% of your loan amount. But you never have to pay it monthly. So there's upfront, there's lender paid PMI, where you take a higher interest rate and the lender pays it. That's not a bad idea. If you make over $110,000, mortgage interest is tax deductible and PMI is not. So that way you just use the interest rate to get rid of PMI and you have more tax write-offs.
So if you buy a home, let's say it's conventional
Mhm.
and it's set to fall off at about 10 years. If you own the home 5 years, then you don't have to pay the rest of the PMI, right?
If you bought it out up front?
No, if it's part of your payment.
Yeah, so there's
So it's
2
kinda-
ways, actually there's technically 3 ways to cancel PMI.
Okay.
There's the automatic way, where if you make a minimum payment every single month, it'll go away when you're scheduled to hit 78% of the original purchase price. So that's usually 8.5, 9 years if you put 5% down. If it's 10% down, it usually goes away in about 6.5 years. 15% down is like 4.5. So the other manual ways to cancel it: pay down your loan balance faster by making extra payments towards your mortgage. And once your principal balance reaches that 80% mark, you can request it be canceled. So that's the actual way to do it. The more common way is property values go up, property values appreciate while you're paying down the loan. Once you are very confident you have 20% equity in the house, you call your servicer and you pay for an appraisal to document the amount of equity you have. So you can call Wells Fargo, services your loan, and say, I want to cancel my PMI and my home value's gone up a lot. Let's get an appraisal order. And they get the appraisal back. You pay like, I think, $450, somewhere in that neighborhood. They get an appraisal done, verify if you have 20% equity. If so, the PMI's gone. You can do it technically. I mean, I've seen people cancel PMI in 2 years after they close, just because property values went up so fast and they bought in the right area and they paid down the balance quickly, whatever you can do.
So there could be a disadvantage of paying. It's kind of what getting out is paying it all up front.
Yep.
Because you don't get refunded.
Exactly.
Nobody gives you money.
That's a sunk cost.
Back once
Yeah.
you put in money.
Mm-hmm.
Okay.
Yeah. I can, I do this for a living, and my first home, I bought out the PMI up front, and I probably could have gotten canceled in like 2 years instead of 4, just because our property value went up. And so, yeah, you just never know. But that's why I definitely educate clients on that, because there's definitely a potential for that being the wrong financial decision. So
Does that only work on conventional, or does that work on USDA and FHA too?
USDA, FHA, all the PMI is set in stone. It is what it is. So FHA charges two types. There's an upfront MIP that's financed into your loan amount. So it's 1.75% of your loan amount that's just financed in, so it's included in your payment basically, but FHA takes that up front and they take it monthly from that 0.85 figure I told you. Can't buy it out, there's nothing like that.
So for both USDA and FHA, you can't, like you said, get an appraisal after 2 years or whatever, and then get that removed?
The only way to get rid of PMI on those two loans is to refinance.
To refinance under the conventional?
Under a conventional loan,
Okay.
exactly, with 20% equity.
And typically it's gonna be, and 20% equity means basically based on the house value on the appraisal, right?
Compared to what you owe, exactly.
Compared to what you owe.
Yeah, your loan to value ratio.
But your interest rate might be higher though, right?
Depending, yeah.
Yeah.
Mm-hmm.
Okay.
Yeah, there's a lot. I hear sometimes clients make decisions, and they're just like, "Yeah, I'll refinance later." And I always tell them to be kind of careful. I mean, I think we're in a pretty good rate environment right now, and I think they'll stay good probably for the next year or so. But after that, it's anybody's guess. It's very possible we could see rates in the 6s in a few years, things like that. So you don't want to base decisions on refinancing in the future when you have no idea what's going to happen with rates. So I always just say try to make the best informed decision you can right now. That way, if rates do stay low and you can refinance later, great. But if not, you made the right decision up front. So another way to avoid PMI, which we actually have been looking at a lot, 2 mortgages. Ever heard of an 80-15? So that's something we see a lot. 80% first mortgage, 15% second mortgage, and 5% down. So the 80% loan is at that 80% mark, so there is no PMI. But there's a second mortgage that has a much higher interest rate. So it's when you really compare the two, payments are almost even, but at least it's interest and not PMI. It also can help you buy a higher priced home with less down, meaning if you have a $600,000 house, you do a $484,000 first mortgage and a second mortgage, and you only put 5% down on that higher priced home. So there's a lot of different options. You can avoid PMI, put less down. On average, if you put 5% down and do 2 mortgages, the second lien rate's like 6.25%. But it's a smaller loan, and like I said, it's kind of the equivalent of paying PMI, but you're not paying PMI. So, like I said, there's so many ways to structure loans out there, and it's not a one-size-fit-all. That's kind of my point. You guys don't need to know how to structure everything, but I just feel like there's a huge disservice out there to clients. That 2-loan structure is especially great if someone's buying a home and they're planning on selling their home after that. So if they're doing a home no contingency, which we're seeing a lot right now, because contingencies, as a listing agent, you don't want to accept that offer, right? If you don't have to. So as a result, the best way to do it is so I see clients get put into a loan with 5% down so they can buy this home with no contingency, and they're stuck paying PMI for like 2 years. So instead, do 2 mortgages, do a huge second mortgage, and then that way they take the proceeds of their sale and pay off that second mortgage completely. You never pay a nickel of PMI, and you have 1 low mortgage loan after you're done. So there's ways to structure that to where clients, can use it as a tool to help them pay as little money out of pocket when they buy that house. What was the other point I was going to make there? The second. Yeah, so I think that was kind of the gist there. There's other programs available. Fannie Mae Home Ready and Freddie Mac does Home Possible. And this is based on the area in which you buy. Same thing, there's income limits. But that's another program that it's amazing how few lenders actually utilize or even know what it is. It's a conventional loan. The interest rate's usually 1/8 to 1/4% lower than your average loan rate, and the PMI amount is cheaper. And the only key to it is just like that USDA map. You look up the address and it says the income limit for this little region is $86,000 a year. If you make less than that, there's no reason not to do that program. The only extra requirement is you have to pay $75 to do a home buyer education class online. It takes like an hour or 2. But you save so much over the life of the loan just by doing that. But like I said, tons of programs out there. Make sure your clients are getting educated on all of them.
Is PMI set differently per bank, or is PMI like a standard
So
formula?
So
Like
There's government mortgage insurance, like the USDA and FHA, which are set by the government.
Yeah.
Conventional loans, PMI is accessed through private companies. So we have the same way that you guys have like lenders and title reps and everybody calling y'all all the time. We have PMI companies that call on us all the time. So there's Arch Mortgage Insurance, Radian, United Guarantee, Essent, Genworth. All these companies all have competing rates. So we shop all of them to see who has the lowest rate based on that client, because they have different strengths and weaknesses. Like I know which client, if you have two borrowers that both have 780 scores, I know I'm going to use Radian because they have really low rates for that. So yeah, it's something you shop around for, and they're privately held companies. And there's like this like price war right now between all of them, and so it's the clients are really benefiting. It's like cheaper than it's ever been to get PMI. So be careful quoting interest rates, y'all. I would avoid doing it at all costs. It's amazing that what goes into them and how much they can vary based on so many different factors. So that's just kind of my only little piece of advice for y'all. Freddie Mac publishes the average 30-year fixed rate on their website, but it's including like half a discount point, and it's based on usually people with higher credit scores, and it's not including government loans. So it's all that stuff's misleading. That's one of the most common questions I get. What's your rate? Between 3.5 and 5%. Like I need to see your loan application to be certain. So it's really hard to nail down that rate. But as a general rule of thumb, right now we're seeing rates in the high 3s and low 4s, which is the lowest they've been in 16 months, which is awesome. Just last fall we were at around 5, so it's really been quite the relief to see that. It's definitely helped the market. It's helped people make move up decisions. It's definitely a good time to both sell and buy.
So when people say prime rate, is that kind of a general term?
It is, yeah. Prime rate is kind of like the Fed funds rate, so it's like the rate at which banks borrow from the Fed. So it has nothing to do with mortgage rates. So mortgage rates are influenced, without getting too geeky on y'all right now, it's influenced by the bond market, and most notably like the 10-year treasury yield. If you ever look on like CNN Money or something, the 10-year yield moves like it mirrors the pattern. So right now it's at like 2.1%. It was at like 2.6% recently. So it's just that when that goes down, I like to simplify it this way for everyone. Like, good news for the economy is bad news for mortgage rates. Bad news for the economy is good news for mortgage rates. It's kind of that simple. If we're in a recession and the stock market's going down, which a lot of people are projecting is going to happen in the next 12 months, it's going to be good news for mortgage rates. If, last year we saw all this, the economy's recovering, Fed's raising rates, everything's going good, and mortgage rates went with it. But they just did it too quick, too fast, and it was a mistake by the Fed, and they're acknowledging that now. And now a lot of people are saying they're going to cut the rate twice in the next year, which is going to be great news for us. So general consensus is bad news for our 401k, good for real estate. So it'll be an interesting next year. So super long answer to your question.
I just heard prime rate before, like from banks, say, oh, you got the prime rate or whatever. I'm like, all right, well, what's that, 3.6, 3.7, what's the prime rate?
Yeah, I mean, it changes daily.
Yeah.
So
and it can change from, the time you're pre-qualified all the way to
absolutely.
you close, right? And it can
and it floats constantly, so you're never locked into the prime rate.
Yeah.
So like when banks lend you money, like whether it's a home equity line of credit or a auto loan, it's usually based on what they tack on their profit margin to the prime rate, because they borrow money at prime and then tack on money for their profit.
Yeah.
That's called their margin. So interesting thing to follow if you're into it is going to be everything that's happening, trade negotiations with China right now. That's kind of like the biggest effector of rates right now. If they make progress and actually strike a trade deal, it's going to be great for the stock market, bad for mortgage rates. A lot of people do not think that's going to happen. And if negotiations fall apart, we're going to see a correction in the stock market and mortgage rates are going to go down. So that's probably the biggest factor that everyone's keeping an eye on right now, including the Fed. And a lot can happen could change overnight, basically. So we talked about fixed rate loans. We have 10, 15, 20, 25, and 30-year terms. The biggest rate break is between a 30-year and a 15-year. You get probably about a 0.5 to 0.75% lower interest rate by going with a 15-year. We talked about ARMs. I've mentioned this briefly, like conventional or FHA, what's the better loan? Depends on a lot of different factors. There is no better loan. Depends on your credit score, what your down payment goals are, and how long you're going to own the home. Let's see. We talked about how many investment properties you can own. We talked about how it affects your interest rate to do an investment property. Let's talk about condos. So mortgage lending for condos is really complicated on a conventional loan. So yet again, if you have a condo listing or your client is purchasing a condo, make sure the lender knows what they're doing. It's probably the most common type of loan to get declined because it has nothing to do with the borrower, it has to do with the condo project. So let's start with the easy part. Sorry, let me catch up here. All right, so here's for the simple part of condo lending. If it is an FHA or a VA client, it's just like that USDA map. It's going to be black or white. The condo is approved for financing or it's not. And to determine that, so if you have a listing that's a condo, you want to go to these two websites. You search FHA condo approval and VA condo approval. And to give you an example, here's the FHA website. Give me a zip code.
78634.
Are there condos in Hutto?
Not really. Ron Arcas.
78664.
All right.
Yeah.
So I recommend just using the zip code because the search engine is just terrible. I don't know. They do not do a good job with it. If you type in the name, a lot of times it won't come up even though it's already on there. So here's the list of condos in 78664. All the way, keeps going down, down, down. Now, what's important to look at is the status and the expiration date. What you'll find is that new condo projects will get themselves FHA approved so that they can sell all their units. And as soon as all those units are sold, no one's ever going to renew the approval. So you can get into the brand new condo complex with an FHA loan if it's approved by FHA, but then it expires. And when you try to sell that condo, FHA is not an allowable source of financing. So if it says expired on the right, no can do. But like Cityside, those are all approved. Donnell Park is approved. Turtle Creek Village is approved. That's about it.
It's all fairly new though.
Yeah, exactly.
Yeah.
So, as you can see, all these Maze Square, Forest Creek, Retreat at Town Center, those are all expired. So FHA is not allowed to be used on those, period. Similar on VA. Just put in Williamson.
So are these all the condos or just the ones that are registered with that?
Just the one that actually ever applied with FHA. If not on this period, it's not eligible.
Okay.
So yeah, it has to say actually approved. These are the 62 condos that are VA approved through in Williamson County. So you can go look through, let's see, Rancho Siena. This is in the process of being reviewed, so it's not, so sorry, these are the 62 that have applied. It doesn't necessarily mean they're approved. So,
So you gotta go one by one.
yeah, if you're looking for a particular project, you actually got to click on it, check it out. Accepted without conditions. That's what you're looking for under status.
Now, do these expire?
In my, I don't think I've ever seen a VA one expire, actually. I think once it's approved, it's approved. I could be wrong about that. I imagine there are a few things. The biggest thing that can ruin an entire condo project is a lawsuit. If someone sues the HOA or sues the builder, it can hold up being able to sell that property for a long time. So to further complicate condo lending, detached condos. So you've seen a lot of those springing up in the Austin area. They have no shared walls, tiny little yard. Those are just like single family homes.
They look like townhomes?
Yeah, but they're not attached. Yeah. Townhomes are not condos when they're true townhomes. A lot of people call them townhomes, but it's a condo regime, so it is zoned a condo. And you look that up in the legal description online, usually if it says you have 0.84% ownership in common interest area, then it's a condo. If it has that verbiage, you're dealing with a condo. So yeah, there are 2-unit condos. Have you guys seen Central Austin? Everyone's buying these houses, tearing them down, and building a 2-unit condo. They develop their own HOA so that they can make more money off of it. It's really common in Austin right now. That's a whole different set of guidelines. But let's talk about conventional loans. This is where it gets really complicated. Conventional loans for a traditional condo complex. Shared walls, multiple floors, things like that. So if you have a condo project and you need to do a conventional loan, we have to do a condo review. So the problem is your client, we can't usually do this condo review. We need an HOA questionnaire filled out by the HOA. They usually charge in the neighborhood of $400 for it. Most people don't want to do that until they're under contract, lender included. We're not going to pay for a condo questionnaire unless your condo is under contract, or your client's under contract. What we are trying to determine, Fannie Mae has a term that they use for condos, is it warrantable or non-warrantable? And the difference between the two is huge. If it's warrantable, we can do a loan, really easy, you get the good Fannie Mae rate. Non-warrantable condos usually require like 25% down in the rates in like the 6s and 7s. So once a condo is considered non-warrantable, you run into a lot of problems there. So now that being said, there's a lot of things that can make a condo non-warrantable, and it's a moving target. It can change from day to day. So the idea behind it, we get a condo questionnaire, and here are the 3 or 4 main reasons why a condo would be non-warrantable. We already went over one. There's a lawsuit against the HOA. Number 2 is that more than 10% of the units are owned by one person. The most common one is over 50% of the units are used as rental properties. So what was a warrantable condo last month, because there were 48% rental properties, someone rented out one of it and moved out, you're now over 50%, that condo is now non-warrantable. So long story short, we have to make our best guess before they're under contract. Usually if it's an FHA or VA approved condo, it'll probably fly through conventional. Call the listing agent, call the HOA and say, hey, have any of these units closed recently with conventional financing? Pick their brain on it. Usually we'll know in advance. The good thing, now that I've thoroughly confused you on condos, is that there is a way around warrantability, because what I was just talking about is a full condo review. If you are buying a condo as your primary residence and you're putting at least 10% down, we can do what's called a limited review, which is basically, do you have the proper insurance? Is there a lawsuit against the HOA? We don't care about occupancy rates, who owns what. So there are ways to get around it. Second home or investment property condo, 25% down gets you that limited review and allows us to move forward usually. So like I said, there's a lot that goes into it, but if someone's trying to do a conventional loan with very little money down, like 3-5%, that's where you run into problems on whether or not the condo is warrantable and can actually do it. So it's hard because the client has to pay option money, pay for an inspection, pay for an HOA questionnaire, and sometimes an appraisal, only to find out the project's non-warrantable and they can't buy it. So condos, just be careful and try to do as much homework as you can up front to make your best educated guess. Because you won't know for sure if they're doing a full review until you get the paperwork.
Nick, what was the owned by one person? What was the percent?
10%. Now that being said, there are condos with like 8 units. So if you own one, you own more than 10%. That doesn't. We don't. You have to have 2 on those types of projects. All right, condos, good times. We did talk about investment properties, about renting your current home out, getting a lease agreement. If you get a lease agreement before you close on your new home, on your existing, we can use 75% of that rental income as income to qualify. So if you have a $2,000 a month lease, that's $1,500 we can use in income. So it helps them qualify it. We can make it contingent to the home being leased out. Kind of like contingent on a sale, but actually getting a signed lease agreement. If someone wants to buy an investment property and has 20% down, 9 times out of 10 they're going to qualify. Another big misconception is that in order to buy in a second home, you have to qualify for 2 mortgages. When you buy an investment property, I'm going to have the appraiser work up a comparable rental analysis, saying what is the average rental rate for that area. Same thing, we'll use 75% of it. Doesn't have to actually be leased out. So we can actually get them income to offset that mortgage payment. So if you have the money and the credit, you can usually buy a rental property. All right, so that is a portion, that's basically a lot of the basics I wanted to go over. For y'all, the main things, just know, like, there's ways to get in with 0 down. Conventional is 3 or 5% down. FHA is 3.5. The other 2 are 0. Those are the most common basic questions. There are lots of first-time homebuyer programs out there. So, who's heard of the Mortgage Credit Certificate? MCC for short.
I've heard of it.
It is an awesome program for first-time home buyers. A lot of lenders don't bring it up because it's extra paperwork for us, but it's not. Once you get it down, it's really not that hard. It's something that really can make them a lot of money back. So long story short, it costs about $700 at closing to enroll in this program. First-time home buyer, income limits, just like all the down payment assistance, same idea. Once you're enrolled in this program, you receive the benefits for as long as it's your primary residence. And the benefit is that you get 20% of the interest you pay that year right back to you on your tax refund. Up to $2,000 a year. So in other words, if you buy your first primary residence and you're paying about $10,000 a year in interest, which is pretty common if you're at $250 or above, you're going to get $2,000 a year back on your tax refund in addition to whatever your refund was. Or if you're self-employed and you owed $2,000, you owe nothing now. It reduces your tax liability based on the interest you pay. So you stay in that home for 10 years, you might get $20,000 in free money from the state of Texas. So it's a very cool program. $2,000 a year is $166 a month. We get to use that as income to help you qualify for your house also, because we know you're going to be getting that money back each year. That has saved countless clients.